What is up guys, my name is Ignas, welcome back to the channel. Today the market is really red and it seems that there are plenty of opportunities to get into, but I would like to bring 3 names that in my opinion will do really well in the long term. So one of the names will be from financial sector, second technology, and the third one is consumer cyclical. I already did analysis on all 3, so today we will try to focus mainly on the positive aspects. I hope that this will be an interesting take, so support the channel by leaving a thumbs up. And with that out of the way, let's start. So first pick is PayPal, ticker symbol PYPL. In exactly 1 year, the stock is down for almost 38%, way under the highs of $310 per share, and we actually today got to the 52-week low at $153.70. Even after this continuous sell-off, the price to earnings is at 37.02, which could be considered quite expensive, but we'll see that it's actually cheaper compared to a few years before. This is here the price to earnings history for the last 5 years. So if we would like to trace the price to earnings that we have right now, which is under 40, we would have to go 5 years back to the first part of 2017, where the PE ratio was at 36.77, and then another quarter back to 2016, with the price to earnings at 34.32. But each quarter for the remainder of those past years had a price to earnings of just over or under 50, and in 2020 we even saw it surging towards 80. So considering buying into the stock right now would give us a price to earnings ratio that was only available around 5 years back. Now another part that I really like is how consistent the revenue increases are. So these are the revenue results for the last 5 years. If we take a look into the results of the trailing 12 months, there was not one report that revenues have decreased. Each quarter was bringing more revenue year over year, which led into this consistent increase for the trailing 12 months revenue chart. It can also be clearly seen in this part at the bottom, where for each quarter there was a year over year increase, with the lowest for it being at 11.62% and highest year over year increase in 2021, up 30.64%. So this consistency is another factor why I think PayPal is a worthy pick for the long term. Third part we will be looking into are the analysts' price targets for the stock. Here analysts put their price targets, so out of 4 to 5 of them, the lowest is at $175 and the highest goes to $366 per share. Interestingly enough, that the current price is at $154. So that is already below where the analysts predict that the price should be in 1 year, and in fact 13.5% below the target price. But then out of those 4 to 5 analyst price targets, the average is at $260.42. So if we believe that on average the price should get to $260 next year, then we are looking into a potential gain of 68.9% or more than $100 increase for each year. So if analysts are correct, then we do have a huge opportunity buying PayPal at the current price. Second name I want to bring up today is Intel, ticker symbol INTC. In 1 year the stock is down for 8.84%. We are way down from the 52-week highs of $68.49, but at $50.50 we are getting quite close to the 52-week low of $47.87. The price to earnings at 9.8 to 1 looks to be decent, but we'll find that that is pretty much the standard price to earnings that Intel usually trades at. On the other hand, if their investments pays out and Intel becomes a major foundry for US, then this could lead into price to earnings expansion that competitors in the industry has, and that would then lead into the price surging. So here we have the 5-year history in price to earnings for Intel, and right now it is trading at a ratio at just under 10. But it seems that it's actually nothing special for the stock. It was trading under 10 in 2020, then just over 10 in 2019, and again under 10 in 2018. So basically buying right now with regards to the price to earnings ratio doesn't give any edge, at least in regard of the last few years. So where does that opportunity come from? So Intel has a plan to catch and surpass their competitors Samsung and TSMC by 2025. And the key to this plan is a series of massive new chip fabrication plants that Intel is building in the US, Europe and Israel. Combined, they are investing more than $44 billion to build these fabs. So if they do manage to catch and surpass a competitor like TSMC, I think that it would be safe to assume that the company should be trading to a similar valuation to it. Taking a look at TSM and knowing that they have the China risk nearby, the company is now trading at the PE ratio of 29 9.12. So that is almost 3 times more expensive than Intel. If Intel plan works and they do catch up, I don't see a reason why they shouldn't be trading at a similar level than competitors. Another part I would like to take a look into is the dividend yield history. So here we have the yield history for the last 5 years. It was quite up there at 2.87% in 2017 and then at 2.86% in the beginning of 2021. But on average in 5 years the dividend yield was at 2.48%. So if right now the yield is at 2.67, it is higher than the 5-year average, and in fact it is above for 7.58%. So the yield was consistently over the 5-year average back in 2017, and there was a slight opportunity by the beginning of 2021. But still buying right now would lock in a decent dividend yield over the 5-year average. So if one is interested in getting a larger dividend yield, this could be a decent bet to buy the stock right now. But I would also like to give a heads up, because on Wednesday Intel is reporting their quarterly earnings, and that unfortunately could make the stock slide as it did before. So on October 21st of 2021 the stock was trading at $56, and then after earnings it dropped $6.50 or down 11.68%. So if we do believe that the sentiment is not quite there yet for Intel, then buying before earnings could be a bit too risky, and we could wait for the price action to settle by the end of the week. On the other hand, if we do think that Intel could catch up to competition, then buying right now makes it a 3x opportunity, and there shouldn't be much of an issue losing a few percents before that. The third name for today is Alibaba, ticker symbol BABA. In 1 year the stock is down for 55.37%, and at the current price of $116.85, we are quite close to the 52-week close at $108.70, and taking a look at the 52-week highs, the stock lost $150 for each share. Price to earnings is at 16.36, which is actually really cheap compared to where it was trading in the last few years. So this is here Alibaba's price to earnings 5-year history. We now have it under 17, but pretty much in the last 5 years it was trading over 20, with the only exception in 2019, where it was possible to get it under 20 at 19.91. But even in the beginning of 2019 it was trading over 30, and in 2018 at over 40, and then in 2017 at around 15 price to earnings. So the stock has been selling a lot, and getting the stock at the lowest price to earnings in the last 5 years looks really compelling. Revenue also looks solid, as we have it here for the last 5 years, so each year-over-year quarter is higher than the previous one. The largest quarter increase was over 100% at 114.2, and we had it at the lowest when the pandemic hit in the beginning of 2020 at a year-over-year quarterly increase of 6.45%. But overall the consistent increases in quarterly revenues resulted in this continuous increase in the revenues for the trailing 12 months, and I don't really have a good reason why it shouldn't continue going on such path. So as we saw, analysts do like PayPal, but it seems that they are rooting for Alibaba even more. The price targets for it goes to the lows of $125.95, and the stock is now trading at $117.39. So on the lower side it is predicted to go up for 10.7% in 1 year, but the average target out of 51 analysts' predictions is $201.94, which means that there is a potential opportunity for the price to go up for over 72%. That would really be an awesome growth to get in just 1 year. And it also seems that super investors are increasing more on their positions than selling. For example, Charlie Munger doubled down on Alibaba, currently holding over 602,000 shares and making up more than 1/4 of his portfolio at 27.65%. Then there was also a decent addition of 35.38%, where First Eagle Investment Management are now holding 2,310,000 shares, meaning that at the current price of $111, they have a position in Alibaba of over $270 million. There are 3 super investors who have reduced on their positions, but it seems that overall super investors are quite confident with the name, so I don't see much of a reason why retail investors shouldn't be. So these were the 3 names that I believe have quite some opportunity going further. If you do agree with at least one of the picks, then leave a thumbs up under the video. I'm already holding 2 of the names mentioned on the eToro portfolio, and if you would like to check those and the rest of my positions, then follow the first link at the top of the description. Also, if you would be interested in getting notified exactly when I buy or sell any stock, then consider memberships. By becoming a member, you will get access to Discord, where I share my stock watchlist and all the buys and sells exactly when I do them. This could be a great option to track my moves closely. I've made separate analysis on each of the stocks mentioned today, so you could find those on the channel or just click on a video that is currently on the screen. And that was it from my side. Thank you for watching, and I will be seeing y'all in the next one.